Hey, Boris Musheyev here, and welcome to another training. And today we're going to talk about, can you invest in real estate and at the same time take a tax write-off, a tax deduction for what you invested? My name is Boris Musheyev. I'm a CPA and a tax strategist. Every Tuesday, I release tax strategy videos here on YouTube. So make sure you hit the subscribe button. If you like the video, please hit the like button so I know that you like it and I can produce more of this awesome content. But really, let's get right into the training. So today we're going to talk about, by investing in real estate, is it a tax deduction? How does it work, and will IRS allow you to take your deduction? One thing you have to understand is that real estate purchase, right? Let's say you want to buy an Airbnb property or you want to buy a rental property, right? And you're thinking of diversifying your assets. You are a business owner, you're making money, you're profitable in your business, right? You've got kids, you got a house, and now you're like, got time to invest in real estate. So like, let me buy a real estate, but can I write it off? You have to understand something. Real estate investment, such as a rental property or Airbnb, is an asset, right? You're basically taking cash, right? You're either buying it with your cash or you're buying it on a loan, a mortgage, doesn't matter. You're investing it, right? You're switching it, right? Cash for an asset. So asset is an investment, right? It goes on your balance sheet, so it's not a write-off per se. So you can't buy $500,000 real estate property and expect to write off everything, right? So you can reduce your $1 million income, for example. But can you still write off a good portion of it, and how does it work? Because most likely what's happening is that you are listening to, or you're hearing all of these TikTok reels, all of these YouTube shorts, right? Letting you know, hey, invest in real estate. This is how the rich do it. You're going to pay $0 in taxes. While all of that might be true, we're going to dissect the situation right now. We're going to talk about your particular situation and see how it may work for you or how it may not work for you, right? So like I said, real estate is an asset. So you purchased the real estate. Let's say you purchased a rental property. First of all, you have to understand, just like any other asset that you purchase, that asset has a depreciation life, right? So if you bought a computer or an office furniture, whatever it is for your business, right, that usually has 5 or 7 year depreciation life. Or you can write it off in the same year using bonus depreciation. With real estate, it's a little bit different. It is an asset, yes, but it has 27.5 and 39 years worth of depreciation. So if you buy a $500,000 property, you can depreciate it over 27.5 years and only get $18,000 deduction per year. So you can't take the entire $500,000 purchase price as a deduction. So if it is a commercial property, the depreciation is actually only 39 years. So that'll give you a $13,000 deduction. So if you buy a property, let's assume it's a rental property, costs you $500,000, well, guess what? You can only take $18,000 deduction on it. Of course, you can take mortgage, interest, property expenses, and so forth. So no, switching cash for an asset doesn't give you a $500,000 write-off, right? Even if you took out mortgage. What happens is that you have to play by the depreciation rules. Now, here's the thing. Everybody wants to invest in real estate, and you hear this a lot online probably. Invest in real estate, pay $0 in taxes. Why and how does that work? Because when you invest in real estate, and assuming it's more than $500,000, it'll give you a much higher depreciation deduction. And there are other strategies to make your depreciation deduction much, much higher, which is outside of the scope of this video. The point is that when you invest in real estate, it gives you what's called a paper loss, right? Let's just write paper loss, right? You can be cash flow positive, but you're going to have a paper loss. Paper loss is basically all the income minus all the expenses and depreciation. Depreciation on a $500,000 property, doing some special depreciation rules and so forth, could actually be about $150,000 in your first year, which is going to give you a huge paper loss. Let's just say $100,000, right? Your first property could give you a $100,000 paper loss, which is awesome. And you're like, okay, great, Boris, so I can go ahead and buy real estate and invest and take a paper loss and still be cash flow positive. No, that depends. Not everybody qualifies for this loss, right? Because if you take a look over here, real estate is considered passive loss. Your income from your business is considered an ordinary income, while real estate is considered a passive loss. That means that passive losses can only be deducted against passive income. So if you are a business owner and you're not involved in real estate, your main business, your main participation is not in real estate, well, you are considered to have a passive loss that is not tax deductible, and it gets carried over to future years. So yes, while somebody might solicit you to invest in real estate and buy in real estate because you're going to get a tax deduction, you have to be careful, right? If your income is under $150,000 as a married filing joint individual, you can take up to $25,000 rental loss deduction. If your income is over $150,000, then these losses get carried forward. You do not qualify to take these losses unless you have passive income. Now, you could have real estate properties that have passive income. That's okay. But generally speaking, the way a real estate investment is done, and if you do it strategically, is to have a paper loss and positive cash flow, right? So like, okay, Boris, if that's really the strategy, how can I take advantage of the paper loss? Well, that is what you have to now consider in terms of tax planning strategies. Look, you cannot save money on taxes if you're not doing proper tax planning, right? And using a strategy. IRS actually allows you to deduct a paper loss if you are what's considered a real estate professional, right? I'm just going to abbreviate it, REP, okay? Real estate professional. Just to summarize it and kind of define it very quickly, real estate professional means that majority of your business, majority of your time, more than 51% of your time is spent in real estate activities, okay? So that's just kind of the first step to determining your real estate professional. Then there are some hours you have to meet and so forth. But basically, once you qualify as a real estate professional, it doesn't mean you have to have a real estate license. You have to meet IRS requirement. Then you can start saying, you know what, Boris, I want to have a paper loss and I want to deduct it against my ordinary income, okay? So to answer your question and to answer the question that get asked a lot, if I start buying real estate, will I save money on taxes? The answer is really depends, right? You can't just jump into buying real estate and think you're going to save money on taxes if you don't have the proper tax planning strategy. Number one, you have to realize real estate, right? So just kind of summarize, real estate follows depreciation rules. If it's residential property, 27.5 years. If it's commercial property, it's 39 years, okay? Now you can do some, like I said, like accelerated depreciation in real estate, get maybe $100,000 deduction on a $500,000 property, but again, this is going to be a paper loss, and paper loss is not always deductible, depending if you are a real estate professional or not, or you have other passive income. So should you jump on investing in real estate? Well, that depends, right? That depends. So I hope this video was helpful. Let me know in the comments if you guys have any questions, and subscribe to my channel. Every Tuesday I release a tax strategy. Release a tax strategy video, and I hope this was helpful. Thanks so much. Till the next time. Got my clicker.